All right, welcome to Market Call. I'm Dan Nathan. It is April 19th. I am joined by Carter Braxton Worth of Worth Charting. Today's episode is brought to you by FactSet, financial data and analytics powered by Tomorrow. They power this fine program that is also brought to you through the YouTube. So if you want to get this every day, Monday through Thursday at 1 p.m. Eastern, subscribe to our YouTube channel. You see the ticker below where to do that here. You can even set a reminder. Carter, I know that you have your reminder on because you're here, and I really appreciate that. You and I got to spend a little time on the Fast Money set last night.
We were. You know what I did after that? Kind of crazy. I went off to the Laura Linney play.
No way.
Yeah, she was in the Ozarks series.
Yeah.
It was good. It was very good.
It's funny, you know, I thought she was kind of miscast in that Ozark show. And, again, I really loved that show. I didn't find them to be, I don't know, that believable of a couple. That makes sense? No, that seemed kind of odd to me. But she's a fine actress. How was the play?
Very good. It was just two people on a stage, and the other woman's quite prominent. I can't remember her name, but not quite at the level of Laura Linney. Yeah. But either way, very, very good.
Look at you. And is
Summer of 1976, I think it was called.
Okay, cool. Is Broadway back in your opinion?
I wonder. They made us wear masks, which was sort of
really
some people quite annoying. Yeah, there was non-negotiable on that. Maybe that's why there were some tickets available, because you know it's a limited show, and she's fairly prominent. But yes, we wore a mask.
All right, I'm just going to say this, not political here, people, okay, whatsoever. I would not go to something in 2023 if I was forced to wear a mask, if I knew it ahead of time. I'm just telling you that right now. I'm feeling like I'd have PTSD about that. I don't know.
It felt a little that way. The funny thing is, just before you, so then I went down to get, I was like, oh, you know, it's nice to have a little something there. They have these solid drinks there, of course, something for, there's some M&Ms or some candy. So I got a little chocolate bar. And she goes, as I'm paying for it, now you can't eat this in the theater.
She just charged you $8 for her.
Yeah, I was like, okay. So of course we ate it in the dark.
All right, of course you did. All right, let's talk markets here, man. You know, it's kind of a funny spot. I think you said it last night on Fast Money. Dom Chu was filling in for the illustrious Melissa Lee here, and you said, listen, we're kind of stuck. You call it a pair of twos, you know? We look at this S&P 500. Listen, and we've been saying this for weeks, and for some of you guys and gals who just think I'm perma this or perma that or whatever. I mean, listen, for all intents and purposes, if I didn't know anything about what I believe to be the second half of this year and some of the headwinds that we have towards the economy and some of the valuation concerns about the stock market and the like, you know, I'd look at this chart and I'd say to myself, it really feels like it's trying to put in some sort of bottom here, Carter. And again, I know we don't want to harp on this every day, but like if you were just devoid of all the commentary that you hear in the market and all the sentiment stuff and this and that, whatever, you'd look at this and you'd say, looking kind of constructive. Is that fair to say right now?
Well, the question is it something that's still in a downtrend? And that is, the answer is no. But is it in a new and confirmed uptrend? Many people believe that's the case. That's not confirmed either, and hence the pair of twos judgment. You would need, importantly, to get above the February 2nd high. Many people are arguing that, of course, it'll be the Apple earnings and Microsoft and all these good stuff that will punch us higher. At the end of the day, though, and this is important, when you're committing cash, right, which is basically safe, to a risk asset, equities or any other thing, you're only going to do it if you have a certain return series or prospective return series that warrants the risk. And so the question is, is one looking at 7 to 10% return on a 12-month basis or not? Because if you're not, or much better, it's not worth it.
Yeah. No, I'm with you. Well, which leads me to the VIX, and we're going to do a trade on the VIX here, people. And let me just tell you, the VIX is not an instrument that a lot of market participants trade. There's lots of ways to kind of get exposure. Let's say you wanted to buy VIX options, you're buying vol on the vol index here, right? And again, there's lots of things going on there. There's futures, there's front months, there's rolls, there's decay, there's a lot of things. So this is, I don't mean to make it sound like this is kind of deep end of the pool sort of stuff, but you can get kind of learned up on this fairly quickly. When I look at the VIX, okay, and this is, like tracking the volatility of the S&P 500, this is going back to January 2022, and you look where that low print is, we're exactly there. We're at 1630 going back to January 2022. The S&P 500 was trading at 4,800. Back then, Fed funds okay, was basically on a zero interest rate bound. On May 3rd or 4th, it's likely to be 5%. So here we are now. We're matched lows in the VIX, okay? And if you just look at this chart, you see that I annotated some of the movements here. There are very few, and I want to just get your take on this, Carter, because you've looked at millions and millions of charts over the course of your history. When you think about stuff that is linked to the stock market, there aren't too many instruments, right, that have 50, 100% moves in a matter of weeks, right? And that's what you see here, right? On numerous occasions, we have 50% plus moves, some higher than 100% moves, which to me makes this a very interesting instrument to trade with defined risk. Thoughts on that, Carter?
Right. So the one thing we know, it's a mean reverting series. So there are no trends per se, other than very long term. And so the here and now chart, what you have, of course, is that can one take advantage of swings, extreme swings in one direction or the other? Just as it spikes, it also collapses. And so, as annotated by you, are we down to such an extent that you're due for some counter trend, some swing in the opposite direction after this meaningful collapse from 30 plus to 16 and a half? And I would say that's a reasonable bet.
Yeah. Well, listen, and so, I think a lot of our listeners, a lot of our viewers here on the YouTube, they know that, like, listen, I try to be, I don't try to be contrarian, but sometimes I really like doing defined risk trades and contrarian setups here. And I think that's what we have here in the VIX. I was talking about the S&P, yesterday, the 413 puts on May 5th weekly expiration. I actually bought those for like 1.25%. And I just kind of feel like I can hang out with those for a little bit because I think we're going to get a little bit of a move, especially with volatility readings where they are. But today, I actually want to trade options on the VIX. I want to trade a call spread. So when the VIX was trading about 1635 today, I'm looking to May 17th expiration. This is really important, people. The VIX expires on the third Wednesday, okay, of each month. Now, we know regular expiration options on most things, these are not the dailies, they expire on the third Friday of each month. So this is not only on the third Wednesday, but it's on the open of the third Wednesday. So it's really important to kind of understand that this is very different than traditional options. So I'm looking at May expiration versus a VIX at 1635. I bought the May 2030 call spread. I bought one of the May 20 calls for $1.50. I sold one of the May 30 calls at about 50 cents. That cost me $1. My break even is up at $21. I have gains of up to $9 between 21 and 30. And then I have a max gain above that. I have losses of that $1 between 20 and 21. And I have a loss of 1 below 20. Now, again, the VIX is at 1630. That's a long ways away, right? 1630 to 21 as my break even. The way I'd be thinking about trading this is if we were to have some form of move, let's say once we get through earnings season, maybe there's some disasters leading, maybe there's some inflationary readings, maybe there's some fear that the Fed is going to get a bit more aggressive than the market is right now pricing for rate hikes. I think you're going to have a VIX above 20. And I don't really need much to happen here, a 30% move to have this a double or a triple. And that's the trade I would take. I'm not waiting for this thing on May 17 to be 30 or higher. If you look at that chart, if we want to toggle back for a second here, those moves above 25 go to 30 pretty quickly, but then they erode fairly quickly too. So this is an options trade. I'm targeting something that I think Carter just mentioned. This is a mean reverting instrument. There aren't too many trends to be tracked here, but if I get my timing right over the next month or so, and we have a spike above 25, this is going to be a risk one to make 3 or 4. Thoughts on that trade idea?
Yeah, I mean, exactly. I think so the point is that you're taking advantage of what is prospectively, we can't know, but an extreme swing in the opposite direction, and you have such an asymmetrical payoff that's what it's right to do. Now, does one take one's entire net worth and do that? Of course not. Does one take a good chunk of change and say, hey, listen, I have to take this bet? The greatest things, here's an expression, I remember once I said, well, I'm thinking of going out on a limb, speaking to someone. I was going to abandon all fundamentals and do charts only and leave a big research position. And the person said to me, Carter, don't you know all the action's out on the limb? You don't sit there hugging the trunk. Yeah. Well, that's what you're doing. You're going out on a limb, but that's where the action is. It's out on the limb.
Yeah. No doubt about it. I mean, listen, and this actually speaks to, there's Armand in the chat, just makes a point here. These guys are timers, not investors. And listen, what we're trying to do here with what we, with our content is this is live during the trading day. We know a lot of people watch it after the fact here. We're trying to kind of give you a sense of some of the things that we're looking at throughout the day. I sit in front of my FactSet machine. I have hundreds of tickers up. I look at, dozens, if not hundreds of charts a day. I read a lot of research notes. I read a lot of stories. I am trying to trade the market. Sometimes I'm trying to do it out on the limb. I think in our other content that we do, which is on the tape and OK Computer, we're trying to be a bit more thematic, trying to think a bit longer term here. And Carter, give me a sense right now, because you talk to a lot of very big institutions, hedge funds, mutual funds, pension funds. A lot of these guys and gals are traders because they're doing some of the shorter term stuff. They use your technical analysis as inputs, right, for entries and exit points and stops and maybe option strikes and futures levels and the likes here. But then you also, a lot of those traders feed into portfolio management teams, right, and strategy teams that are making big, broader sort of macro decisions. Talk to us a little bit how you think about trading versus investing, because they are, to Armand's point, very different skill sets. But to me, I think understanding the other, if you were more inclined to, let's say, be an investor, and understanding some of the techniques that go into trading, I think are also really important.
Yeah, it's always ever thus. I mean, so my bread and butter business for 32 years as a sell-sider on Wall Street is to, as a research analyst, right? Now you could do it fundamentally, quantitatively. I'm a technical analyst, of course, is to one of three things is for idea generation. So portfolio managers, traders, analysts looking for, hey, what do you think is maybe bottoming out here? What's breaking out? But also for portfolio reviews, people saying, look, we want to go through all our holdings. If you see anything that's a little bit worrisome, maybe we'll reduce. If you really like, we can add to it. But also for just one-offs. Hey, what do you think of this one before earnings? And the point is that at the institutional level, not to say that's any better than the individual level, the main thing is knowing who you are, right? There are people who are mandated, can't hold cash, long only, must be mid-cap TMT, technology, media, internet. And so they can't do healthcare, right? So it's very specialized, sliced and diced. And to that extent, that drives a lot of the behavior, right? The mandate. But if one is a generalist, it either gets down to this. Either you say, over time, markets go up about 69, 70% of the time. More Gillette razors sold every year over time, more babies, more Oreo cookies. I want to be long only. I want to screw around with any of this. I want to buy the SPY and play golf. And that is a perfectly valid approach. On the other hand, there are people who want to try to do better than that. Now, the risk with trying to do better is you do worse, right? But that they want to have active roles individually or professionally to try to beat that ever sort of ominous, hard to beat benchmark that is the S&P 500. I'm in that camp, and whether one does it fundamentally or one's time frame is short or long term, it's all about sticking to your discipline, right? And then maybe end with this. There are only three time frames, as known, right? There's minor, intermediate, and major. I myself am not really interested in major moves. I mean, Apple's been on a major move for the last 25 years. Okay, great. So is Johnson & Johnson. Minor moves, couple hours, couple days, couple weeks, not my thing. Intermediate moves, 3 to 4, 3 to 6 months. I think that's where real alpha is generated.
Yeah, no, I agree. And Armand, I'm just looking at some of the comments. He's getting all up in my grill here. He doesn't seem to like us or the program. I'm not sure why you're still here, bud, but maybe put that in the chat. Let us know. He said, you're missing the fact that earnings decreases in Q1 are better than Q3 and Q4 suggest earnings at bottom. I mean, that doesn't really suggest that earnings have bottomed to me, considering what I think is the sort of headwinds. And that's why we pay so much attention to what the companies are saying in these earnings reports and reading the Qs and the like here. It seems like there's not a whole heck of a lot of visibility right here. All right, let's talk a little bit about a couple names that have caught my eye today. UNH, let's pull this one up here. It's getting hit. Humana's getting hit. This is kind of an interesting one, Carter. I feel like, if we look at the move that we had about a month ago in this thing, it was kind of getting washed out. It was getting towards a level. It had a big run. It broke out. I think you highlighted it on the day that it was breaking out above that downtrend. Okay, if you look at that going back a month, but look at that. It's given it all back almost, right? And so when you see a move like that, there was a lot of folks who probably were kind of getting pretty excited. This has a pretty big weight in the Dow Jones Industrial Average because it's a high price stock here. Thoughts on a move like that? Because it seems a little herky jerky here.
Herky jerky, what a great expression, and it is exactly what this is. Other words that come to mind are schizophrenic, meaning untradeable, or said differently, it speaks to the fundamentals. How does UnitedHealthcare, which is one of the biggest companies in the S&P 500, a very specialized business, very domestic, has no currency issues, has no Putin issues, has no Russia or Taiwan issues,
Yep.
healthcare stable. How does that stock move, if you will, from $46? I know it's $460, but just to put it in the here, $46 to $53, now back to $48.
Yeah.
It got cheap, it got expensive. This is the issue. And one could try to square it off fundamentally. Well, it got cheap and then it popped, but now listen, right now, here and now, I think it's kind of untradeable.
Yeah, no, it's interesting. I guess the one point I would say is it caught my eye on that first big gap day when it gapped above that downtrend that had been in place over the last couple of months. It felt like, a move, and in 3 trading days got right to its one. I think that's the 150 moving average there, and then overshot it. And so to me, I find that to be an interesting move. Might I take a look at it when it kind of fills in that first gap, you know what I mean, from a few weeks ago? So we will take another look at that. I want to pull up Schwab here. This is one that we've talked about a little bit. And again, I think that all of our viewers, listeners know that we were not inclined to kind of press shorts into the reports of a lot of these big financials because we thought a lot of bad news was kind of in it here. It's had a big 3-day move. After it reported Monday morning, it was down in the pre-market. It rallied to close up. It's had 2 consecutive up days since then. I feel like, Carter, this is a nasty setup. I almost kind of want to put a short out on this. And I don't mean a naked short. I mean maybe something, a put spread or something like that. I feel like this company is likely to raise capital, and maybe the powers that be are trying to goose the stock up a little bit so they can do a capital raise somewhere near where the stock was trading a few days ago, and hopefully put that kind of, call it a headwind or whatever you want, out of the way. So to me, that looks like a pretty decent setup. Fundamentally, I don't think there was anything in their quarter that suggested that I want to be buying this, especially after the reversal and the 10+% move it's had off of those recent lows.
Yeah, collapse, obviously news related, a ricochet. I mean, or even more conservative, could one sell like a June 60, 62, or 65 call spread? Some that say, hey, look, okay, maybe bounce a little further, give myself some wiggle room. But the upside, and it's not because I say so, the upside's capped to some extent, because when you take a hit like that, you have people trapped, right? Not only trapped up at 80 before it broke, but there are people who bought the first day down when it dropped to 65. And there are people who bought the second day. Well, this is really cheap now at 60. Okay, after doing that, when the stock goes as low as 45 and your cost base is 62, you got a big problem, right? And so that when relief comes, if and as it comes, reprieve, get me out, I can get out of this nightmare, 62, 64, you return to a level where that mentality kicks in. Interested sellers above who came in thinking, quote, I should buy this Schwab, it's cheap, but then it got much worse. Having endured a move, let's say from 65 to 45, now seeing it back at 56, 58. At what point do those sellers emerge? Soon.
Yeah. I want to pull up Cisco here, and this is interesting to me. It's down 4%, and maybe actually we could pull up CDW. So this company is a reseller of hardware equipment, and they had a pre-announcement. Stock is getting absolutely creamed today. So this is CDW here, and it closed yesterday at 190. It's trading at 164, and so some of the kind of tech hardware net names are down in sympathy with this. Cisco down 4%, like I said. NTAP is down nearly 3%. IBM's down 1%. And then, like this might be an interesting precursor. Hewlett's also down to, what we might see of some of these hardware providers. Carter, one of the things that I find that, this sort of gap in a name like this on fundamental news is something we got really used to last spring, and a whole host of names. Remember the gaps that we saw in Target and Walmart when they're talking about inventories? We saw them in some of the, the Metas and Netflixes, right? When we saw some big misses or so. And one of the things I find interesting about the last, call it 5 or 6 months or so, we haven't had too many of those massive gaps in names that we care about, that we want to kind of try to extrapolate to maybe different sectors or some bigger names. Thoughts on that? And then if they could pull up the Cisco chart, because this is not a small company, it's not one that we talk about a lot, but they sell into a lot of enterprises, they sell into governments. They sell into, like end markets that I think are important as we're trying to kind of evaluate the strength of enterprise spending. Thoughts on the big CDW gap, and then when you see a move like this in a stock like Cisco on the back of it?
Right. So to your point first, there is, as always, when you have news, it is either better than expectations or worse, and you get a re-rating of the security. The consensus is what people anchor to, for better or worse.
Yep.
And so all of these drops and gaps are important in the sense that if you're really in a great environment overall, you have a limited number of these things, right? But we're starting to see more of them. And this is even with, of course, the revised earnings numbers down. Now, going back to 1970, typically analysts revised their earnings down 1% a month. And we're seeing an even more accelerated rate for this quarter on an annualized basis. But the drops and gaps are serious business. The first thing to do, more often than not, is to resist the temptation to buy the gap. I have it all the time. I go, my God, this thing's down 30%. I gotta nibble. Just don't do it.
Yeah, no, I agree with that. All right, one last one before we get to the big kahuna. We're going to do a little Tesla preview here. People I know we've been talking about a lot, but Carter has not only a technical view here, but he's also going to lead with some fundamentals, as he likes to call them. But let's look at Bank of America. Okay, so Bank of America had really underperformed many of its money center peers. Okay, and over the last month and a half or so, really since early February. And, it rallied in sympathy last Friday when we had good reports from JP Morgan, Wells Fargo, Citi. Okay. And it actually moved higher yesterday after its earnings, but it's giving some of that back here. And interestingly, we don't draw any lines here. This is our chart. This is not worth charting material here. This is us just pulling this up on the fly here. But Carter, if we're just eyeballing this a little bit, some of the others got towards their 200-day moving average or the 150. In this case, the stock kind of got stuck at levels that were prior support, right? That maybe seem a little bit resistance. This is an important name to me. If this were to kind of head back towards 28, it might lead me to believe that some of the other ones, right, might kind of join the party to the downside because there's some kind of problems lurking here. Thoughts on Bank of America from the technical setup?
Yeah, I mean, look, it's like so many, and you could look at insurance stocks. The weakness, news related, and then the ricochets. Does it have room to run? Could there be a little bit of follow through? I think that's, how would I say it? Well, for me, maybe that's unknowable or too hard to do here and now. I think the real message is unless you're really doing day trading, and it's just not what I do, I think you just stay away. You try the best decisions, sometimes the ones you never make. This is the kind of thing you just sit on your hands, let someone else fight this out. I would not put on a big short here or a big long. I would just sort of stay away.
Yeah, and I guess my 2 cents on that is I don't disagree. There's nothing that compelling to me other than maybe being a bit contrarian from the recent move. And so to me, I'm more interested in seeing how it trades because that might help inform some other views that I have in and around financials. All right, let's talk about the wisdom of the crowd. Let's talk about Tesla. So Tesla's going to report today after the close. We already kind of previewed it, I think, earlier in the week on one of the pods here. The implied move is not small, okay? And this thing has actually moved around a lot after earnings over the last year. I'm looking at the stock at 182.5 or so. The implied move in the options market is about $13 in either direction. That's just tomorrow. Talk to me a little bit because you put together a bunch of data for us, which is not something I am used to seeing in your worth charting reports here. There's a lot of fundamental data. You want to talk a little bit about how the street is viewing this stock.
Yeah, I thought for this conversation, and there are no judgments about that data. It just shows how vague it all is, and it's why charts have their problems, but the problems are nowhere near the problems associated with the guesswork of what a stock is worth 12 months hence. Let's look at in no particular order. So, just for instance, if you look at the blue down right now, the Tesla's price per share is 180. And Wall Street has a 12-month price target. This is not one analyst or 5. This is 50, right, of 208. And so when you consume that information, that advice, how do we consume it? Well, they're saying if we buy here at 180, it'll be worth 208. And again, the error rate of one man or one woman, but not 50, right? And not just 50 random people, all people who have gone to typically great universities of some kind in order to get those jobs at Goldman Sachs and Morgan Stanley and Bank of America and more, Credit Suisse and so forth. And then not only do they have those big university degrees, they get hired, they're certified. They have CFAs and CPAs and MBAs. And then they take all that and they apply their knowledge to General Motors and Ford and to China and to consumer spending trends and auto sales, everything. And then, so with this, should we buy this stock based on the consensus that it will be $208 down on the bottom of your screen in 12 months? Well, let's say we tried that exercise a year ago. Look up. So in yellow, a year ago, Tesla was trading at 325 and Wall Street said it will be worth 320. They're very cautious, said it won't go anywhere. Did it go anywhere? It's trading at 181, 180 right now. It's down 45% from where consensus. This is not a point of making fun of Wall Street. It's not their fault. It's undoable. No one knows where the hell a stock's going to be 12 months out. It's absurd.
Yeah. And so you had some data, and I think this is really interesting. It's a good little TikTok of some of the things that we look at when we're trying to kind of put together a trade idea or just kind of rethink an investment idea. Let's talk about institutional holdings. So, this is one where you see some big, capital pools. Some have been adding and some have been, been selling. And a lot of this, this is all pretty random stuff too. Some of these, these fund managers might have owned the stock since the IPO in 2010. Exactly. And some might have bought it when they got all geeked up about it a year and a half ago when it crossed $1 trillion in market cap. And maybe they're also selling here, or maybe they're averaging down.
Right. And so the point is, just as the sell side analysts who, without being particularly flipped, have no skin in the game. They're just writing about it, right? They're of an area that's hard to cope with. Well, this is the buy side. Now, there's this notion of smart money. Now, honestly, look at those names. You're telling me those people on the top, those people are smarter than the ones on the bottom, or vice versa, the ones that are selling? That's absurd. There always is the circumstance where big money is adding. You can see that. And big money is selling. Look, I have a cameo here. Oh my goodness, you need.
Look at that guy. Look at that guy.
Can you say hi? And I'll give you my phone, and you go over there. Okay, I love you.
Daddy, I have.
Oh my.
I have a Triceratops truck.
A Triceratops truck. Wow.
No way.
Okay. All right, you go take this. I love you. I love you. Take that. All right.
That's gotta be.
My goodness.
Like something from the Transformer.
Must be Triceratops and a truck put together.
That's pretty good stuff. Well, let's go. That is one cute child there. Let's go to. I love these charts right here that you have the 2023 EPS estimate versus the stock price, and you see.
Yeah,
we can see a trend there, huh?
Here's another a way to. So this is. It's not their fault. I did this for them. That's why I got out of this. I couldn't stand it. What you see is the stock price in black, and you see the 2023 estimate for this year. So notice that the stock goes up all through 2020 and 2021, and analysts are revising their estimate. Tesla will earn $3. Actually, it'll earn $4. It'll earn $5. It'll earn $6. And so the stock starts going down, though, which you see a year and a half ago, and analysts are still revising there. So they say in 2023, it will earn $6.10. That's where they were as recently as 7 months ago. And now they've changed their mind. They say it's going to earn $4. 6 till 4. Meaning all they're doing, it's not their fault. Again, this is just they're just following the price. If the stock goes up, they revise their earnings up. If the stock goes down, they revise their earnings and their price target down.
Yeah, well, I don't disagree. One of the things I'll just say this is that one of the pillars of the bull case here for Tesla has been the earnings and margin expansion story and their early lead in EVs. But you know what? The truth is they have a huge issue going on with China right now. And I think it's not really been focused on too much by the bulls here that, they have tremendous competition in China. We've been talking about the competition here, in Detroit from the Koreans, from the Germans, from the Japanese. And you know what? No one's really paid attention to that, but they have real competition in China. They're losing market share. They've gone from 14 to 10%. Now, that doesn't mean a whole heck of a lot if you think about how quickly maybe expanding that market is and their push towards EVs, but there's a price war going on and they keep lowering prices. I think they've had 6 price cuts across many of their important regions. And so if margins are going to be under pressure here, I think a lot of investors are saying, okay, well, maybe, you know what, we can handle that in the near term. But if they're going to make it back in volume and then their basically have the ability to kind of get leverage out of their infrastructure, whether they're pricing, that they have with the input costs and this and that, whatever. Fine. I just don't see it. So, you guys know I've been short with defined risk here. I'm keeping it into the print. But let's talk about the levels here, because last night on Fast Money, Carter, I said that I think it's kind of a one up, kind of two down scenario. Like, yes, if the implied move is, $13, could the thing be up $20 towards 200 in a heartbeat? Yes,
Sure.
it could be, if it's not as bad as expected. But if it's worse than expected and people are starting to extrapolate this out a quarter or two, of problems, stock's going to fill in that gap, in my opinion, towards 150, which was the gap from the January earnings report. So talk to me what you see in the charts here.
Yeah, so we'll move through these fairly quickly. This is going back to the COVID low, of course, $30 up to 400 and change. Let's put some lines in. Let's put some more lines in. Put some more lines in. It's very symmetrical, right? I mean, it lends itself to uptrend, downtrend. Now the question is, but the here and now is a little more nuanced. Let's keep going. And so if you look at the here and now, we're sort of muddling. We're not quite, we had that basically collapse from 200 to 100, down 50%. We have the ricochet, the 100% recovery, 100 to 200, and we're kind of stuck. Let's keep going. So here's with the 150 moving average. And then the next iteration, if you were to do the relative strength. Now this is a two panel and you're looking at, again, Tesla on the top. It's a bit squunched because it's got the two panel, but look at the relative performance. Its stock is up since March, but it's not keeping up with the S&P. I don't like the setup. Again, my thinking is to be short into the print, but certainly if you're long, buy some puts as protection or take some measures. That would be my thought.
Yeah, and again, this goes back to our friend Armand, and he said there's no rigor here, just guessing. And again, we've been doing this a long time, and when you're trading things into an earnings print, it does tend to be very binary, especially if you're doing it with defined risk and using options. So I will concede that, and I'm not a huge fan of a lot of retail investors punting that way. I've been doing it for a long time. I risk what I'm willing to lose. In this situation with Tesla, I've had a pretty decent trade on and a winning trade for the most part over the last, let's call it, year or so. So I have a little capital to kind of play with here. But I'm not doing it in the weeklies either, because if I get the direction wrong, then I'm wrong. I'm doing it in May, because oftentimes in a name like this that's very controversial, you might have a move that doesn't make a whole heck of a lot of sense because it might be short covering or something like that. So again, that's the way I'm also playing it, but it's not something we're encouraging our listeners or viewers. Nothing that you hear on these program, on Market Call, or on the tape or OK Computer. It's not investment advice, people. We're just kind of giving you the different inputs that we're looking at and some of the decisions that we make. And hopefully that helps inform some of the things that you do. All right. One last thing before we get out of here, because it's in the auto space. You and I were talking about Ford and GM. And I got to tell you, Carter, this Ford chart really looks like, I think I said, a disaster waiting to happen. You see that $11 level here. This is a 1-year chart. And I just look at that move that we had, late last year, I guess mid last year. The fever broke. Here we are. We're back along the bottom here. If we look at a 5-year chart, we see that the stock is below its 50 and it's 150, and everything we just talked about in the auto space. I mean, we went from tremendous demand and super undersupply and a hard time getting workers, hard time getting components, like the list goes on and on during the pandemic. Now, if you drive around in any like kind of suburban area and you look at a Ford or a GM dealership, they're packed with cars, right? At a time where interest rates have gone up very high. And so there's just less demand for the cars here. Thoughts on my little lines that I drew on the Ford chart? And I got a quick trade for it.
Yeah, I look, Toyota Motors at or near 52-week low, so it's not acting well, as the expression goes, for GM. It's not the case with BMW and Mercedes, but in general, I don't like the space. Maybe I have one comment about rigor. Is that okay for Armand?
Yeah.
Okay, so Armand, I talked to today one of the top 15 holders of Tesla. They called me. Why the hell would they do that? Because there's no rigor?
Yeah.
You don't know what you're talking about.
Yeah. Hey, listen, Armand, come back tomorrow. We'll have another one. All right, real quickly on the Ford, and this is me, maybe not particularly rigorous, and just punting. I'm a gambler here. if I'm looking at this thing, I say to myself, I think we're going to kind of break this $12 level. I think it could be a straight shot to 10, and it could overshoot if there was a guide down when they report in the first week of May. So I wanted to find my risk today when Ford was trading at about 12.35. I could look at the May expiration 12 put costs about 50 cents. You can do the math on that. That's just a few percent. It's a break even down about 6% or so. And what I'm trying to do in a market like this is, like, if I want to be kind of bearish in a market that I've just said, it feels like it wants to go higher. Buyer, like sell-offs are getting bought here. I get it. Okay. I want to look to kind of make some of these sort of little chippy trades here. I'm going to cut my losses if the stock starts moving higher or just goes sideways and the option starts decaying. I'm going to cut my loss at a 50%, mental stop there. That's the way we do it. So that's the way I'm thinking about Ford. We'll definitely update GM and Ford. We'll definitely update Tesla. We really appreciate all the work that you do, Carter. We appreciate you coming on Market Call. If you guys want to see the rigor that goes into the work that Carter does, go check out worthcharting.com, because some of those reports are about as good as it gets. And for me, technicals are a really important input, and I need a guy like Carter to help me through this thing, because sometimes just looking at one picture doesn't do it justice, right? It's thinking about different time frames and sort of different analytics that you are choosing to kind of measure the value of a chart here. So Carter, thank you very much, bud. We appreciate it, bud. All right, thanks. All right, everybody, that's going to do it for today's Market Call. I want to thank FactSet, financial data and analytics powered by Tomorrow. They've certainly powered me here. They've certainly powered all of our charts and all the data that we've provided during this Market Call show. So I'm going to be back tomorrow at 1 p.m. with Liz Young. That's EY from SoFi. We appreciate you being here. See you tomorrow. Thanks. Bye.